back. This is Boomer Life on CL 650.
Yeah, I wish. But are you where you want to be financially? The well-thought-out financial future takes good planning, an integral part of building the life that you want for yourself and your family. And today we're getting great advice from Jim Doyle, Senior Financial Consultant with Investors Group Financial Services, and talking about ways to stay on track financially. Jim, I really like how we've been covering the benefits of working with an experienced financial planner. Benefits like comfort, peace of mind, confidence, excitement, and fulfillment. However, I think it's safe to say that even though many of us might be working with an advisor, as we inch ever closer to retirement, we are just not that confident about being able to sustain our lifestyles on our retirement paychecks.
A recent study from Mackenzie Financial highlighted how 4 in 10 Canadians believe they're in a better financial position compared to a decade ago. But only 25% of those closest to retirement echoed this sentiment. Now, I normally shy away from a lot of facts and figures, but I hope you won't mind if we share a few of them today in support of this conversation.
Now, we talk about Mackenzie Financial. That's one of your sister companies, correct?
Yes, it is. You know, this study shared some concerning insights. Specifically, of Canadians 65 or older, 42% stated that their financial positions had not changed drastically in the past decade, while approximately the same portion stated their lifestyle has changed negatively over the past 10 years.
Well, I would seem to suggest for a substantial percentage of those over 65, they might not be seeing their financial situation deteriorating.
One of the most troubling findings was that less than 35% of Canadians in the 55 to 64 age group believe they are definitely on track to meet their retirement goals.
That's a bit of pessimistic news, perhaps suggesting lack of confidence in retirement planning and being able to sustain their lifestyle.
The survey finds, for example, that 37% of Canadians who are typically preparing for retirement, those age 55 to 65, don't contribute to an RSP.
Now, is that number a little higher or lower than the average for all age groups?
It is a little higher. And I think the study's authors suggest 35% of Canadians don't contribute to RSPs. But it also highlights a couple of noteworthy figures. Only 18% of Canadians overall feel confident in their contributions to an RSP, and an overwhelming majority of Canadians, 72%, do not have a written financial plan in place.
Well, what's the significance of not having a written financial plan?
We spoke earlier about the benefits of financial and emotional security, but I think Carol Bazare, a Vice President of Tax and Estate Planning with Mackenzie, said in a statement about the study, people who worry about their financial future but don't have a financial plan are like people who worry about getting lost but don't use a map. Both a plan and a map are easily available. Both reduce a lot of stress and typically help you reach your destination.
Should more Canadians be seeking financial advice then?
58% of Canadians don't use the services of a financial advisor.
Now, that seems like a high number, especially as we spoke of earlier. Those who work with an advisor over 15 years on average add 290% or more to their portfolios than those who do not use the services of an advisor.
One positive from the study, those who do use a financial advisor tend to be more knowledgeable about financial products and confident about their financial situation. Now, there are some headwinds to overcome. The study mentioned how saving for retirement may be confusing for many Canadians, with 29% feeling indifferent, 23% feeling overwhelmed, and 20% confused when it comes to their investment options or retirement savings.
I still can't get over that difference in assets by working with an advisor.
According to the 2016 Serrano study, there are two significant factors which account for this difference in assets between those with advisors and those without. One factor is a higher rate of savings for those with an advisor. If you have a financial advisor, you increase your savings rate. And if you increase your savings rate, doesn't that mean you have more investments?
You increase your wealth. Did the study offer any stats on the impact of savings rates when working with an advisor?
Yes, it did. It said Canadians with an advisor have an annual savings rate of 10.75% compared to non-advised Canadians whose annual savings rate was 6.7%. If you can imagine how doing this regularly over a period of time, saving more than a third more, that's got to improve your bottom line.
Oh, absolutely. So what was the second major factor?
The second major factor that plays a role in the ability to increase assets is financial discipline and better disciplined behavior. The discipline to look at and monitor your plan regularly. The discipline to stay in the markets through both positive and negative cycles, as well as the value of balanced market portfolio advice and the benefits of diversification.
Now, I hear this one all the time, diversification. Yeah, I'm still not sure exactly what it means.
It's a great thing to understand because it's one of the most important tools available to investors. Diversification allows an investor to reduce investment risks while potentially improving investment returns. The fabled, don't put all of your eggs in one basket. But here's the problem. On some level, it might be counterintuitive. And I've had this question asked a few times. Why in the world should we invest in a mixture of investments where some do well and others perform poorly? Why not invest only in the good investments?
Well, it is an excellent question. Do you have a simple answer, though?
I do, okay? The reason why investing only in the good investments doesn't work comes down to one simple fact. We don't know the future. Future performance of stocks and other investments rely heavily on future events that no one has any reliable way of predicting. And that is why we must diversify. But this can be tricky for many investors who believe they are well diversified. But on closer inspections, they're often concentrated in a single asset class.
So what does real diversification entail?
Well, it should start by ensuring you have more than just many holdings. It might mean owning multiple asset classes that behave differently in various market conditions and respond differently to various economic events.
So if I had a portfolio of just tech stocks or one of only dividend-paying stocks or maybe high-yielding corporate bonds, I might not have good diversification?
You're right. Even some portfolios that include both stocks and bonds may not be sufficiently diversified. Take, for example, a portfolio of U.S. stocks and high-yield corporate bonds that are both dependent on the fortunes of the U.S. economy or U.S. companies. Okay, if they're highly correlated, that means they move in the same sort of direction. Okay, you can see them all going down when the markets fall.
Isn't this what I want my investment advisor to be looking out for?
I want to burst a major investment bubble. Advice that seeks to consistently outperform the markets is realized by few financial advisors. Yet it seems many are hardwired to seek this out. So it's not surprising that while some benefit, or some will benefit from professional guidance, 28% are unsure of where to turn to get professional advice.
Well, we hear it all the time. Too many Canadians not saving enough money and constantly worrying about their finances. If this all sounds completely overwhelming, consider giving Jim a call. 604-682-5431. Creating a comprehensive written financial plan could be a great place to start.
You know, many clients have told me that the most difficult part in this process is to walk through the door of my office and admit that they weren't managing their money or setting goals. But once that first step was taken, they felt relieved and wonder why they didn't engage in the planning process sooner.
Peace of mind is priceless. And like you mentioned earlier, imagine traveling to a destination without a map and having no idea how to get there. That's got to be pretty unsettling.
There are three things that everyone has to have where money is concerned: clarity, confidence, and control. Understand what options you have at your disposal, how the decisions you make impact your personal life and finances, and what the trade-offs are for each decision.
All right, let's try this for an example. You're talking about if you save a little more or reduce current spending, what does that mean for your future nest egg? Or if you retire 2 years earlier, how much less will you have to live on?
Precisely. Asking and answering these types of questions helps ensure that the decisions you make are right for you and aligned with your values. I meet people every day who are not confident in their financial picture, they're not confident in the choices that they might have to make, and they're not confident in their financial knowledge. I'd really like to help give these people back that sense of confidence. My job is to help you live the life you desire without worrying about every bill.
Well, some anxiety surrounding money is natural, I guess, and it can be a good thing. But when it comes to when it starts to affect your quality of life, it is probably time to start thinking about how to prevent or reduce the stress.
Financial lives are like flight plans, okay? There are all kinds of things that will throw you off course, and it's about the corrections that you make to get to your destination. You may, for example, choose a detour based on changing priorities or unexpected events, such as illness or job loss. Having a framework to understand and assess your decisions along the way offers a sense of confidence because you know you can be back in control fairly quickly.
Jim, you've been doing this for 27 years. That gives me a sense of confidence. You know how to direct my flight plan. And listeners, if you're troubled by your investment situation and you're not sure about your options, I would encourage you to take that first step. Get a second opinion. There is help available. If you're listening to us right now, you can reach Jim at 604-682-5431 or at jim.doyle@investorsgroup.com.
Absolutely.
There we are. So mark that down, make the call, or make contact. It will do you an awful lot of good. Moving along, Jim, what are some of the biggest concerns that you might have to monitor and reassess in your financial plan on a regular basis?
Well, there's certainly a couple that come to mind. One is ensuring that you have enough income or cash flow to meet your current expenses. And this is especially difficult when you may not have a firm handle on what your average monthly expenses look like. Determining which assets can be used to provide cash flow as needed and whether there will be temporary or long-term.
Might be easy not to think about retirement in terms of changing cash flow need. Maybe I was just thinking about getting the same monthly check and working with that. But you do raise a very important issue here.
Well, here's a major one not to overlook. The tax consequences of your choices. Most of us are living much longer, and we want to enjoy a quality of life through most of it. Any financial miscalculations in retirement could be something you might not easily recover from.
In other words, you need to get this right.
Maybe I can use this analogy, okay? If I don't watch my weight, I have to do something to take off the excess weight, okay? And that's not always fun. By watching what I consume, having a little regular exercise, and visiting my doctor regularly, these are steps that I can take to monitor my health. Now, my financial health really isn't that much different. The difference here is that I can easily see my belly. Money's ability to serve me well over time is not so self-evident.
It is the $1 million challenge right now, isn't it?
Many of the families that we work with have substantial investments, and it's not uncommon for them to have not put a lot of thought into implement their retirement income strategies. They're not facing any income challenges now and haven't explored how their future needs or what you're going to do to address them, and much hasn't been done with regards to tax planning and estate planning. For these families, we can really help.
Avoiding the pitfalls these issues create takes planning, the type of planning that a written financial plan can explore. It's clear that nearly every financial decision you make or you don't make can impact some other aspect of your financial present and future. What would be some of the topics that you might encourage discussing?
Determining which assets generate income, which ones to take income from, and in which order to redeem assets, I think that's big. Add in tax planning and estate planning, and you have a start on your own personal financial cookbook. The trick is ensuring, as different financial events transpire in your life, that you make sure that your financial plan stays relevant to your changing circumstances. When those relationships are personal, I think the planning comes easy.
As we said earlier, a lot of investors look for ways to become more comfortable with protecting their retirement income streams. What's the best place to get started?
If you haven't done so already, create a written financial plan and update it each year. In its simplest form, the plan will show where you are, where you're going, and what it will take to get you there.
You're listening to Boomer Life on CIL 650. I'm George Gordon. I'd like to thank you, Jim, for sharing time and ideas with us today. We've been talking with Jim Doyle, Senior Financial Consultant with Investors Group. Everybody wants to be on the road to a comfortable retirement, but knowing how to get there is a different story. If you're unsure as to where you're headed or if you're in the right direction, why not give Jim a call? Put your mind at ease. You can reach him and his team at 604-682-5431 or email him at jim.doyle@investorsgroup.com. I'm George Gordon. This is Boomer Life.